If you've been an energy buyer for any length of time, you will be pretty familiar with the chart on the right. Um, it is a very commonly shown chart to the point that I think it might be the most popular energy market signal that anybody looks at. The dark blue line on the right is the 5-year average. The lighter blue line is where we are today, and then the shaded gray region gives you the 5-year range. So it gives you a quick snapshot into what storage levels are, how we're comparing today versus the 5-year average, and you can also see the seasonality, right? The injection season when we push more gas into storage, and the withdrawal when we take it out for winter heating. Um, it is updated every Thursday morning at 10:30 a.m. Eastern, which also gives people a regular talking point, which I think also contributes to it being a pretty commonly used chart. The chart on the right is a roll up of the regional data that you see on the left, and so you can actually see where each region is in terms of the kind of current year 12-month range, the 5-year range in the gray, and then the diamond in today's price. Um, the the usefulness of this, people will occasionally talk about it at a weekly level, right? Of what was the expectation for the injection or the withdrawal, and then what was the actual result, and how did that move prices. When we did a multi-year look back, there's not much of a predictive factor there. Half the time we will miss the injection, miss the forecast, and half the time we will miss it on the other way, and half the time that will push up prices, and half the time it won't. And so it's a talking point, but it's not actually that useful on a week to week basis. What is useful is at a trending basis, our delta from the storage levels to the 5-year average does have some price predictability. And so the difference between that light blue line and the dark blue line, as that gets bigger, we have a surplus of gas in storage for this time of the year. You will see prices drop. And then as that gap gets bigger the other way, where we have a deficit in storage, then you'll see prices rise. And so we're going to show that on the next slide here on slide 5. And I know the chart looks, I don't know if you can minimize make that a little bit bigger. Thank you, Jack. It's a little bit crazy to start, but the gray dots on the far, before we get to the colors, the axes. So on the bottom of the chart is the delta from the 5-year average. So as we go to the right, we have a surplus. We have more gas in storage than we normally would for this time of year. As we go to the left, we have a deficit. And then on the y-axis, vertically, we have the price. And so you can see as we have more gas in storage than normal, so as the dots are further to the right, they're also lower, right? The price is lower. And then as the dots are to the left, prices are higher. The gray dots are the years 2015 to 2020, and they're all pretty much in this consistent, fairly linear trend line there. They're all in this similar cluster. This used to be one of the strongest price signals, and it was very stable for the longest time. When 2021 happened and we were recovering from COVID, and then into 2022 as Russia invaded Ukraine, that's where you see these big green and red circles, and the price really went up despite the storage levels not really supporting that amount of price deviation. So that was a pretty abnormal event where that went up. And then you also see the blue diamonds are this year's prices. And so that one blue diamond up at the very top in that $750 price range on roughly a zero surplus or deficit, that was Winter Storm Fern. So those are kind of our big outliers. But in the interim, the blue dots on the bottom right, the yellow dots on the bottom right, and even the pink dots in the center, that's calendar years 23, 24, 25. So we've recovered this signal quite a bit. And all this to say, kind of this box on the bottom left, what does this image mean for me? Well, if we take out those 13 years of outliers, 13 months of outliers, 17 months, 13%. If we take out those 17 months, 13% of outliers, you'll see that if you follow that trend line, a 10 BCF delta, whether that's up or down, should imply a penny movement on the near-term gas contract from a 285 baseline. All that to say, the math says we're about 100 BCF from 100 BCF above where the 5-year average is, which implies we should drop 10 cents from that 285, yielding a math price of, May should be 275. When I was putting this together over the weekend, it was trading at 268. When I checked this morning, it was 269, 270. So it is a decent predictor. It's not perfect. There's still very much reasons that prices could vary from this. Uh, and one example of that is I had to throw out 13% of the data. So the 13%, there's still a decent chance that prices can go haywire, but it's useful to predict short-term prices. Everything I just showed you was kind of predicting the 1 month in front. This chart is showing you what that price looks like 1 year, 2 years, 3 years down the road. So the blue line on the right, the kind of bright blue on the right, that's the current forward strip. So that's if you go up to any of the websites to pull down Wall Street Journal and NYMEX, the CME Commodities Exchange website, you can look at what each month is doing, each trade month, and that's that seasonality that we see going out into the future. You can also compare that to the dark blue line, which is what prices have settled at. If you've taken no action, then you just pay the settle rate. If you don't do any sort of hedging, and that blue line has been volatile over time. You can see the Russia invasion of Ukraine, kind of in that 2022 time frame. You can see the 2020, the COVID drop. So there's some economic stories in this chart as well. And then the green line is just taking that same historic data and then correcting it for inflation. And the reason I say that, the reason I think it's useful is if you just look at the reported nominal prices, they were above $4 a quarter of the time over these 195 months that we have that we're looking at. If you were to correct it for inflation, historic prices were above $4 47% of the time. So it's about 50-50, right? If you kind of draw that a line in your mind on that $4 price point, the market's half the time it's above that and half the time it's below that. And we're starting to see the forward strips average below that, 8, 9, 10 years into the future. So if you have the opportunity over the last 15 years, right, to hedge, the last 15 years it's been around $4 on average, and you can go hedge anywhere from 2 to 10 years out in the future at just below that. It creates an opportunity to build up that layer and to build up that budget protection to start hedging out, to start adding those layers in. On the next slide here, we'll talk. The other reason I like the $4 as a mental target is there's a fair amount of production across North America that is recoverable. So gas, the cost to produce is less than $4. So there's a lot of recoverable gas at that level, up to 40 years worth. We do have a little bit more gas that we can get if prices were above that, but we have plenty of gas that we can produce with today's known resources, today's technology, at today's rate of $4 per decatherm. So it's a nice mental framework to say, if we see prices below that, that's especially if we're looking at any unhedged portions, and we're worried about trying to protect our budget, it's a nice time to consider layering something in for that. Next slide, I wanted to just talk about the supply and demand changes coming in 2026 and 2027. So on the top right, you have the natural gas year-over-year supply changes. And so in 2026, you can see that our imports are going to drop a little bit, but our production is going to go up. And the net change of those two things is that we expect to have 1.32 BCF per day of additional gas available on the supply side when 2026 is all said and done. So it's taking the historic so far and forecasting out the remainder of the year. On the bottom chart, it's the same idea where it's the year-over-year demand changes. And so for the 2026, the purple line is exports. Mostly that's LNG. So there's a big, demand increase from exports, but that's offset slightly by lower demand on the industrial, commercial, and residential side. And so the net of all these demand drivers is that we expect there to be a 1 BCF increase in demand in 2026. And so on the left, you can just see, in 2026, the net impact is we're going to have an extra roughly a third of a BCF per day. And then in 2027, we're going to go to almost a -1 BCF per day deficit. Again, just indicating that is a price signal that suggests prices might soften in 2026, but they might rise in 2027. So the prices will always balance out to try to help production and demand stay in line with each other. Storage being that last piece, which can fill in the gaps, and that's why that storage delta matters so much. Is that if supply and demand aren't quite in line, it's storage that fills that supply gap. Uh, I'll note that before you go on to that next slide, Jack, thanks. I'll just note at the bottom here, these forecasts change all the time. So if we were looking at this in March, the difference, instead of being, a 0.32 BCF increase in 26 and a minus 0.93 change in 2027, those both would have been much, much closer. So last month we were looking at about a 0.2 BCF difference, a 0.2 growth, and then a 0.2 deficit. So really in just the last month, we've seen demand forecasts increase quite a bit. And that's just a comment to say that these things are always changing. It's really when these kinds of demand and supply signals say the same consistent thing for 3, 4, 5 months in a row, that's when you start to see prices respond pretty quickly. The first 3, 4, 5 months in a row, that's when prices respond. The first 1 or 2 months that they're out of alignment, you tend to see the supply or demand forecasts tweak first. It's really when they're stable for a few months in a row that we start to see the prices move. So potentially a leading indicator here. Thanks, Jack. This is perfect. And I just wanted to talk about the largest demand driver on that previous slide was that purple line, the LNG exports. That we are seeing that grow, and we're seeing some pretty successful construction projects completing some LNG gas terminals. So on the left, this is the daily feed gas demand, and feed gas is the amount of gas that goes into the LNG facilities. They then consume some of that gas to pressurize and liquefy the natural gas and then send it out on a tanker. So from a grid demand perspective, we care about feed gas because that's the amount of gas that's taken out of the supply. But from how much is the U.S. exporting, which sometimes economists and GDP would measure, they care more about exports. And so on the right, you can see that the feed gas is that dotted blue line that's 10% above the actual exports. And the exports data comes from the EIA, which is always a little bit lagged. So the LNG feed gas data is a more useful metric for us. And it's just to show that on the far right, the shaded region is the actual LNG export capacity. So it's the facilities we've built that can push gas out on these tankers. And you can see from, we were 2016, we didn't have any exports, and we grew that over 5 years to close to 10 BCF per day. We had a flat LNG growth, 23, 24. We didn't have any more projects coming online, and prices definitely softened as production ramped up, knowing the producers looked at this too. They knew that the LNG demand was coming, which it's starting to arrive now in 25 and will continue to grow up through 27, and then having some big kind of ominous looking demand cliffs coming up in 27 and 28. So just to say that we're seeing a lot of LNG growth, and that will continue. I'm sure those of you who are on this have been following some of the news out of Iran with the Strait of Hormuz, and that controls 20% of global LNG. And with some of the action that's happened there, Qatar lost about 1.7 BCF per day. They think it's going to be down 3 to 5 years of global LNG supply. The U.S. is replacing that fairly quickly with our own export terminals coming online. But there's certainly a lot of demand globally, and LNG prices are high. And producers in the U.S. domestically will do everything they can to get that gas onto a ship and get it out because the financial incentives are just so strong. Moving to the next slide. Apologies, there's a lot of text. With our technical difficulties here, we couldn't quite animate it through for you. But the real summary of this from a risk management perspective is that top bullet. It's just don't be 100% exposed. If you are concerned about forward costs, any sort of a way to balance your budget or keep those costs stable, anything that's concerned about year-over-year increases, we're at a reasonable time to start adding in protection. The question really isn't kind of whether to buy; it's just about of how much to buy. Depending on how risk averse or risk tolerant you are, you might take a more or less aggressive position in terms of the hedge percentages. But you have an opportunity to hedge at fairly reasonable rates from a historic perspective. And then there's all the other market risks. So the why now, it's hedging against those LNG exports we just talked about. We haven't talked as much about the rest of these. Those might be opportunities for future NAM Energy Pulse uh, talks like this one. But certainly the data center growth is going to need more power generation, which is going to come from natural gas. We touched briefly on Iran. There's other global events. The Venezuela, U.S. action in Venezuela reduced the amount of oil, which changes China's mix in terms of what energy they import. Europe is also a big demand center for natural gas through LNG. And so as they make changes to their grid and reduce or increase their reliance on LNG, that changes the dynamics as well. Weather is always a big risk. We're forecasted to have a slightly hotter than normal summer, especially in August. So paying attention to that as an energy buyer. The interconnection queue, that's the amount of the amount of load and generation looking to come onto our grid. So there's been pretty big news items, especially in PJM and ERCOT. If you're in either of those regions, you should absolutely be paying attention to that one. And then kind of the regulatory changes are somewhat always there. In most cases, having a contract early and treating that appropriately in the terms and conditions is to your benefit. If you look down at the why wait section, there are isolated cases where you actually would want to avoid fixing that into your contract terms. Depends on which particular one we're looking at. Right now, some of the costs in New England and New York, and even parts of PJM, I'm thinking New Jersey and Ohio, have elements that you'd want to potentially wait from a regulatory change perspective and just pass that through on the contract. And then there's also, the why wait is all those risk factors we talked about in the first section. Potentially one of those would not happen, which would help soften prices. Generally, there is a higher risk of recession. In recession, we tend to see demand fall off, which then helps soften prices. And so if we end up in that sort of environment, sometimes that can be beneficial for prices, although not beneficial for business. And then also infrastructure changes, which I'm hoping to do a deeper dive on sometime soon. Just the amount of pipelines and transmission lines and new generation that's trying to be built can also help alleviate some of the price congestion areas. So I've talked for long enough here. You've probably read the right box here to just say that we talked about NYMEX and the natural gas commodity. There's a decent price environment to consider looking at that. There's power also in some of the other areas where we're seeing prices at close or trending down to these 3-year lows, and I'll show that a little bit on the next one of the upcoming slides here. But that said, even if we are in a high price environment, given those risk factors we mentioned earlier, it still might be beneficial to add protection because we might be in a high price environment that's moving higher. I'm thinking especially about some of the regional areas that are either exposed to LNG, like New England, or potentially exposed to less generation coming on than expected, like New York. We're definitely seeing some of those areas that prices are high, and yet that doesn't seem to have as much relief opportunity as maybe we would hope. Thanks, Jack. We can go to the next slide. I just wanted to go through a couple more things real fast. We've gone through the bulk of this, but on the next slide, you'll see the pricing distribution. If you could go one more, please, Jack, which shows each blue dot on the left, each blue dot is a different day's trade, and then the diamond is where we are today. So today's price versus the last 3 years of prices. So as the diamond's further right, we're in a higher price environment, and as the diamond's further left, we're in a lower price environment. So you can see California, we're setting record lows on the power out there. On the natural gas side, what I'm showing here is basis. So basis is the cost difference between the NYMEX, the Henry Hub, the national benchmark, and wherever you are. So in New England and New York, prices are very high. In Texas and the Mid-Atlantic, those are gas producing regions, and so they actually have a negative basis because it's cheaper there than it is in Henry Hub, Louisiana, which is the national benchmark. And then the regional storage levels that we looked at all the way back at the first slide can also impact some of these regional basis elements as well. So just wanted to give you that. Again, these slides will be sent out. So if you wanted to explore or reach out to us if you have a specific region you're interested in. On the next slide, this is just some quick news roundup items. So we mentioned the Strait of Hormuz, 20% of oil and 20% of LNG flows through there. So that's a big supply bottleneck for the world. Every day it feels like there's a new news item where we're closing it, it's not closed, it's blockaded, it's not blockaded. There's mines, it's a toll, it's a fee to pass. It's heavily manipulating oil prices. Domestic gas prices are fairly insulated because we are not dependent on external gas. We are an exporter. We send gas out. And so our domestic natural gas prices have been fairly insulated from this. I will say that as you know, if the strait remains closed for a long time, that $150 per barrel is an interesting line in the sand, where that's about where the recession risk turns away from a risk into a reality. So that's one of the things to consider. If you are in New England or PJM, there are absolutely capacity auction things happening. I don't want to go into too many details here, but you should be paying attention to those. And it would impact your demand response participation as well as any sort of load shedding or the way your bill is structured. You'll see charges moving from energy to demand side. So any sort of demand management opportunities can be useful there. Interesting news in March was the first time that the renewables were the largest generator of electricity in the U.S. Natural gas has been the number one since it overtook coal about a decade ago. Renewables are trending up. They outnumber fossil fuels in the interconnection queue about 4-1. So we will expect to see more and more renewable growth. That said, there's very much a seasonality to this. So natural gas will absolutely reclaim its top spot when we come to the summer. But it's just been an interesting trend to see the grid grow that way. And then again, we've touched on this briefly, not enough time to go into it in depth, but the load growth, especially from data centers, and Texas especially came out with some very aggressive growth forecasts within the last week or two, and was received with a lot of skepticism, and they said they needed to go back and check the numbers. But the numbers are fairly staggering. So I don't think what they have posted is going to happen, but some amount of load growth is likely. And then the next slide, this is just a reminder. So if you are doing demand response, you need to act now to get those get your plans in place. Your demand response provider needs to submit their bids, and the deadlines are often late April, maybe early May. So you got to act quickly. And then if you are considering any sort of a solar investment, there's a July 3rd deadline in terms of the 30% ITC. I say 30, can be 30 to 50 depending on a few factors. So, but if you are considering any sort of a solar project, you should be hyper aware of that deadline because that's 30+% of the project value that you don't want to make sure you confirm with your developer. With that, we've got one more reminder of on the next slide of the strategic document. We spent a lot of time talking about commodity today and how that risk can be controlled through hedging. A little bit about contract risk as well. And then the last slide here is the next one, which is a reminder of upcoming the next Energy Pulse item, and then some additional resources, which when we send out the files, you can click through. So I took us pretty close to the end, but Jack, if there are any questions, I'd be happy to talk them through. Thank you all for attending, and thanks, Jack, for manning the slides.
Absolutely, and thank you for sharing some of those insights with us, Ben. It's very topical. Hopefully that helps our participants cut through the noise when it comes to energy-related headlines. We'll go ahead and remind, if you do have any questions that you'd like to ask, we do have a brief moment. You can either enter them in the chat or put them in the Q&A window. I will also remind that we will be sending out the recording to participants for this webinar 24 hours after the commencement of the webinar. So you'll have any of that information that you would like to review on hand and ready for you. And go ahead and give it another minute to see if anyone would like to ask any questions. Perfect. Well, we're right on time, and as it is 12:30, we've come to the conclusion of our webinar. Thank you again for joining us for the NAM Monthly Pulse series. Our next webinar will be on May 19th, and we look forward to seeing you then. Thank you very much for your expertise, insights, Ben, and thank you to all of our participants for joining us today. Good afternoon and good morning.
Thanks all.